Doing it. So again, this is a conversation of a fireside chat that I'm having with Latent Wealth Strategy. My name is Jon Kovach Jr., and I'm here with Mark Steiner and Steven Steiner with Latent Wealth Strategies. And we're going to be chatting tonight. I'm going to have them present to us as they would to others, and they're going to give us some really great information and just show us what we need to know about the offerings that they have, as well as the solutions they've created. And I'm looking really, really forward to this discussion and this opportunity, as well as a really great time to introduce some of my really close friends whom I've come to know, and they're going to be teaching me a little bit more about latent wealth and the strategies behind it, and why this is an incredible solution for, Americans everywhere, families everywhere, and business owners everywhere. With me today is Mark Steiner, founder of Latent Wealth Strategies, and Mark has decades of experience in the financial industry. He's run businesses. He's turned businesses around. He's seen billions of dollars pass through his fingertips as he's worked with a lot of industries, and he's just got a tenure of experience working with businesses and individuals. But most importantly is Mark's been on a mission to solve problems. He's really good at solving issues. In fact, I think one time over lunch, Mark and I solved the world political issue together, all in one sitting. But he's just incredibly minded and very, very well respected in his realm. And with Latent Wealth Strategies, he's got some incredible things he's going to be teaching us tonight about. And then joining us too is Steven Steiner, son of Mark Steiner, working with Latent Wealth as well. And Steven is the one who actually introduced me to this. Steven and I became friends quickly over a golf match, and soon became even closer friends, business partners, and then, peers in the world of business, and working together on a lot of things. But I'm grateful for Steven's influence and just a lot of the stuff that we've been able to do together. And then this connection and this collaboration has come because of the various opportunities that are through Amplified Minds. So I'm just going to let you guys take it off. This is your presentation. I'm here to learn, and I'm here to become a client because I want to know more about how this will help me and how easy it is going to be to fix a few areas of my life through some of the strategies and through some of the tools and resources you guys have created.
Hey, John, thanks for the introduction. As always, it's hard to live up to the introduction. So
I keep making them better.
Hey, well, listen, we appreciate it. Latent Wealth is, and Steven and I work together. Latent Wealth is a company that's an consumer educational company in the financial services arena. Our entire purpose is to see if there's a better way to grow the resources that we work hard to earn. And if there's a better way to establish not only short-term dollars, but mid and long-term dollars for retirement planning. And so long time ago, we started looking at the way people do business. And I'm going to share a screen here in a moment. We're going to, if it's all right with you, John, we're just going to run through a presentation that we might share with clients to give them a perspective of what we do. Hopefully your viewership might have some questions on that, and we can kind of go from there.
Absolutely.
And of course, interactive here, happy to answer any questions. But the baseline of where latent wealth comes from is really, if you take a step back and you look kind of the two roles that we play as individuals. Number one, we educate ourselves in a chosen field or a chosen profession, and we become very good at that. And that's why we're called professionals. But for everything that we don't do professionally, we rely on professionals, right? So we wear two hats. We're consumer at everything, and then we are professionals in one area of our life. When you look at a business model, I don't care what it is, we've talked before about this, but let's say you're Apple, the company Apple, you develop a phone, you put apps on it, you do all these things, and the purpose of that is really to sell that to a consumer and make some money. So you have an agenda to make money. As a professional in your own business, it's the same thing. Whatever you're a professional at, you want to be paid, your value, and then that's how you make your living, and you're good at what you do. And so you have an agenda. Well, a consumer has the reverse agenda, right? Whatever you're selling, using the iPhone as an example, I want the phone. You're the developer of the phone, but you don't actually want the phone. You want the money that is generated by selling the phone. Me, on the other hand, I want the phone. So when we come together in business, we both have a separate agenda, but we're able to marry that and both walk away having solved our agenda, right? We've met our agenda and our goals. So when you get into the financial services arena, this is the only business arena where I think there's actually conflict between the consumer and the industry itself. Unlike the phone versus the money, when we go to the financial services arena, what we're looking for is we have accumulated some dollars and we want those dollars to grow. So we turn to the professionals and ask them, hey, can you help us grow our money? And the answer is, yeah, we're the professionals, we can help you. The difference in this transaction is what we want out of our money, which is more money, is the same thing the industry wants out of our money, more money, right? So they want our money and we want our money. So you can see there's a little bit of a conflict here. Now their agenda is to make money, so they develop products that will make them money. The products that they're selling us have to have some value to us, otherwise we won't take them, right? And so the value and the things that they provide us are maybe some money, but in many instances other things. So we can talk about whose agenda is being served, in this presentation that we do with clients kind of do that. But the long story short is that almost anything that somebody needs to do, let's say it's January 1st and you set your New Year's resolutions, I'm going to lose some weight, I'm going to get fit, I'm going to get healthy, I'm going to do this. It's a good idea. We all jump on that bandwagon, and 30 days later, we're back to our old ways, right? I'll get to the gym tomorrow, I'll run that mile later. And change is such a difficult thing to do, even when we know it's proper. Sometimes we don't meet our goals because of that. So Latent Wealth has kind of looked at two things here: the industry, the financial services industry, what they provide us in their agenda, how we can use those same products and tools, not for their agenda, but rather for our agenda. And then we look at the whole challenge of change and the fact, how hard is it to change and implement a new something. And so what Latent Wealth has done is said, we're going to figure out how to do that without making any change. If you don't have to make much of a change, you're probably more likely to engage in that practice. And so having said that, if you're all right, let me go ahead and introduce this slide. Stephen, any comments you want to make at this point?
Yeah, I'll let you go through the slides. You're going to be sharing that from your computer. Just to kind of touch on two things really quick. So we're Latent Wealth. It's Latent, which is another word for dormant, right? And so I think when people hear we're talking financial strategies and things like that, your first thought is you're thinking investments. Want to kind of preface this whole thing. It's not an investment strategy. Investment strategy, in Mark will get into this a little bit in more detail, working with your discretionary dollars. But we're just talking about, you have a bunch of money, the dormant dollars, right? Your latent dollars that right now are just kind of, it's your monthly cash flow, things like that. Those are the money, that's the money that we want to address here, the money that's currently not working for you. And so people who are going to be listening to this, don't get hung up on an investment strategy or anything like that. This is just, this is an all of your money strategy to kind of help you capitalize on your non-discretionary and your discretionary dollars. So that's all I got.
Perfect. Okay, well, let's go ahead. I'm going to share the screen. You let me know if we're on par here. Are you seeing my screen, Latent Wealth Perspective?
Yep, we're good.
Okay, fantastic. So this is kind of where we start with clients. Having made the introduction that we do, we talk about latent wealth, having a unique perspective that using financial services industry products, we're going to better serve our own agenda in terms of saving and creating wealth and wealth accumulation. So latent wealth, our baseline motto, and the way we try to introduce and work with people is really to change nothing, multiply everything. We feel like that's a pretty low hurdle, and if there's good opportunity without much change, then we're likely to be more successful. So when we look at the industry, we really break it down into three main financial service industries. One is the banks, the other is the insurance world, and then of course we have Wall Street. While they all have their own purpose within the industry, they all are separate there, but they have a common goal, and the common goal is to get our money, right? Banks want our money in the form of deposits. insurance companies want our money in the form of premiums. And of course, investment Wall Street, they're looking for our investment dollars. They're all clamoring to get as much of that as they can. And so they do a variety of different things to do that. The other thing they have in common, though, is that they have money managers. So it would be ludicrous to think that all the deposits that we put in a bank or premiums in a policy or an insurance company or the investment dollars that we give to Wall Street, that they don't have somebody who's an expert at managing and growing that money. And their knowledge on that is probably as good as anybody in the world. And that's why they work in these places to maximize the growth on each of those sub-industries within the financial services world. And so when we look to see who's benefiting, we know banks can grow the money we give them. We know insurance companies grow the money, and we know Wall Street grows the money. So we know they're benefiting. The question is, what about us? And the answer is, we're not the benefactors of that growth. If you think about it, going back to serving agendas, banks grow that money, but they're not really inclined to share it with us. Same with insurance companies. And so what we have done is taken a step back and we said, let's just talk about our money, the consumer, the one who earns the money. And we break that into two categories. We have a non-discretionary subset of that. And non-discretionary is simply the dollars that we earn that have been pre-allocated to something else, like a mortgage. I make X amount of dollars a month, and but I have to set aside Y every month to pay my mortgage so I can live in the house that I'm in, or I can drive the car that I am, or the cell phone, or those kind of things. So these are non-discretionary dollars that are just allocated every month. Then we have discretionary dollars. I like to call these lifestyle dollars. These are the dollars we say, hey, I'm going on vacation. Hey, I want to eat out, or I'm going to eat in, or kind of function in that environment. But we have choices over those dollars on a monthly basis. And what did I do there? If you break those dollars down and look in a traditional sense, about 70% of the dollars that we earn are allocated to this non-discretionary environment. Those are the dollars that we pre-allocated to our bills, cars, houses, student loans, taxes, those kind of things. And what we're left with are these lifestyle dollars. Maybe 20-25% of that is what we decide what clothes we're going to buy, where we're going to eat, the kind of things we do on a monthly basis. And then a subset of that, maybe 5 to 10% of those discretionary dollars, we recognize we need to put to the future. So we need to put that in savings. Maybe we need to set aside money for college education or long-term retirement strategies. And so our breakdown is most of our money's pre-allocated. Some of it we have to enjoy the day. And then we take a little bit of that, the 5 to 10%, and we put to the future. Now, our lifestyle and our life expectancy has changed over the last decade or two. We are living almost as long as we are saving for retirement. You think about when somebody graduates from school, gets into their profession, and gets settled, they might be putting money away from age 30 to age 65. So that's 30, 35 years that they are working. Well, we live in retirement. Our age expectancy is now pressing 90, 95 years. And so it's very possible that we could live in retirement very nearly as long as we are in the workforce. And if that's the case, then that 5 to 10% of the money that we are allocating to our future, putting in savings, that needs to grow to cover virtually 100% of what we're earning right now. You could almost look at it and say, whatever I'm saving today in year one of my savings needs to cover the cost of retirement in year one in retirement. Then year two has to cover year two. And as you think that through, what we're really saying is about 5% of our money here, 5 to 10, needs to really replace 100% of what we're earning now if we want to maintain a similar lifestyle. The chances of making that happen are pretty slim. And because it's not working, we are looking now, a large majority of Americans are looking for alternative sources to retirement. And so the idea of traveling, enjoying time, getting free, new cars and vacations and traveling the world are being replaced with supplemental income opportunities. Where do we work to supplement our Social Security or the retirement plan that's not sufficient to pay our way? And so, you got to hand it to this lady. She's making the most of probably a career choice she didn't have in the in her mind earlier, but it's just kind of the way dynamics have happened. So we look at the latent wealth strategy, and what does that actually mean? If you remember our first slide, we had banks, we had insurance companies, we had Wall Street, and they all serve a purpose. Well, if you think about why we use each of those or what value they truly provide us, this is where we can start to see the value come to us. If we look at a bank really provides two things for us: safety, right here, and liquidity. Those two things are the reasons we really like banks, is because our money is safe and it's available to us. So when we pay our bills, we can do that. But we can effectively pay our bills one day out of the month, and the remaining 29 or 30 days of the month, the bank's just enjoying growth on our money without sharing it. So what latent wealth says, hey, wait a minute, if we can maintain safety and if we can maintain liquidity, but also take advantage of some of the rules that the insurance industry provides, maybe lesser known, we can put the latent wealth strategy to work on what otherwise used to be bank dollars. So let's go back to this non-discretionary money. One of the things that we know about non-discretionary money is that we're earning 0% on that, right? Do you agree with me on that?
Yeah, absolutely.
The sitting in the bank, they're not paying us any notable rate of return for the dollars that are sitting there. We know that if we take, so those dollars that are currently generating a 0% and the 5 to 10% that we're already putting away to the future, if we take that and combine that in a structure, a financial structure, living by the rules of what the insurance industry mandates, then we can have a better result. And if we were to do that, you notice that our lifestyle dollars doesn't change. We're just simply using what is already allocated to go out the door for bills and what's already allocated to go out the door for our future. We're going to structure that in this lifestyle strategy, or this life insurance strategy, without affecting our lifestyle over here. That's where we don't have to make any changes, which most people appreciate. So let's look at what the value of life insurance is. And these are things that some people know and may have heard of, but don't really know how to apply them. But let's break insurance down into two categories. We got term. Term is simply, I'm going to buy it today. It's going to last a given period of time, maybe 10, 20, 30 years. And then at the end of that, it's over. So if we're successful at living, the money that we put into a term policy ultimately becomes a waste to us. We got no value out of it, right? Then there's the flip side of that, which is the permanent. This basically says as long as a premium is paid, insurance, the death benefit will stay intact for us. And there's different products. There's whole life, there's variable, there's universal index. There's a number of different products that the insurance company will put forward to us to try to capture our attention. But they do, within the rules of life insurance, I'm going to go back to this for a second. One of the things that I think about life insurance is when people buy it, it's really for the purpose of death. So I think maybe sometimes the name might be better served as death insurance.
Yeah.
And we call it life insurance, sounds a little more appealing, but most of us buy it for death, which is death insurance. That being said, there are tremendous benefits that we can use while we are actually alive. Let's take a look. The safety. So we can put our money in a structure like this and maintain the same safety and liquidity that we get at a bank. So we're now seeing the value of maybe looking at banks a little differently and maybe looking at some of the value and benefits of life insurance. We can maintain that same safety and liquidity. We can actually get the growth that we anticipate in something like a 401k or an IRA or some other investment. We actually can do that without taxes, which will now kind of emulate a 401k or an IRA of some sort. So safety, liquidity, growth, tax avoidance. We pick up a legacy benefit, a death benefit that can provide our family in the in the event that we die. And then the other thing that it provides is a loan provision. The loan provision is an interesting subject because people have different opinions about loans. John, I'm going to ask you this since you're with us here.
Yeah.
Do you look at a loan as a good thing or a bad thing?
Great question. In my opinion, a loan is a good thing, but paying it off is a bad thing.
Okay. You and 300 million Americans kind of think the same thing.
Right.
I love a loan because I get what I want now that I might not have otherwise been able to get. If I want to buy a house, unless I can have enough cash to buy the house, I'm going to be living under the bridge with, I guess, the rest of the people that can't buy a house with cash. And so it allows us to get what we want when we otherwise couldn't get it. The other thing that's good about a loan that most of us don't pay attention to is that that transfer of money to us is non-taxed. We love money that's not taxable to us. As a matter of fact, we pay accountants to figure out how to take the money we do get and minimize the tax on it. So we do have a tax aversion, and loans actually are one of those tools. So we can get what we want and we can get that money without a tax consequence. What's bad about a loan? Debt accumulation. We don't like debt. We would rather be out of debt than have debt. The other thing that probably, as you mentioned here, is it's not so much the loan that I don't like, it's the terms of repayment that concern me, right? If take a mortgage, it's the biggest loan we're probably going to have, and it's the longest lasting loan that we're going to have. And so if I've got to pay a certain amount every month to the bank to keep my house, there are no assurances that I'm going to have my job for 30 years uninterrupted, or I'm going to have income uninterrupted for 30 years. But the repayment terms of that loan demand that I make a payment every 30 days uninterrupted. And so those are the things that are a little concerning for us. But if you understand the terms of the insurance loan, it's a little bit different. And what it actually does when we put our strategy on it, it actually takes that loan, and instead of it being a bad thing, it's actually a good thing. And here's why. One of the things that's nice about a loan through this strategy is it doesn't affect your borrowing power or your credit. A lot of times when you borrow, if you get a credit card, you may not be able to get another credit card, or you might not be able to qualify for a car because you run into limits there. This doesn't affect any of that. There's zero qualification. There's no one asking you any questions about this money at all, and it's immediately available to you. Most importantly, there are no immediate repayment obligations. So think about that for a moment. If I can get what I want now through a loan, but I don't have any obligations to pay it back, how good is that loan?
Yeah, it's
You ought to be doing backflips on that one, right?
yeah.
So let's think about what that could mean on a house. If you could go to a lender and say, hey, I want to buy this house, it's $500,000 and I want to buy it. And the lender says, I will give you the loan and you don't have to pay anything on this house until you sell the house. We'll settle up at the end. Would you like that type of loan?
It sounds nice.
It would be fantastic for two reasons. Because if you did lose your job along the way, you're not at risk of losing the house. The other thing that you might get the benefit of is what would normally be the mortgage payment. Let's say it's $1,000 or $1,500 or $2,000. That money is no longer a non-discretionary set of monies. That could go into something else, maybe an investment, maybe something else you want to do. So if you could get a loan without immediate repayment obligations, that would be the best of both worlds.
Absolutely.
In the insurance world, that's what happens. And basically they set the provisions on those loans that you don't have to make any payments on that until you die. And that works perfectly, because once we die, we don't mind if that's when we have to pay the loan back. It's while we're alive that the loan's a problem, not while we're dead. So they have created a great structure for us to not only borrow money, but allows us to use the money for our benefit along the way. And then we can pay it back at death. And guess what we pay it back with? The death benefit. Right. Interestingly, think about a life insurance and a death benefit. I might pay $100 and get $1 million death benefit, right? The $100 was mine, but the $1 million was not. That's the insurance company, correct?
Yep.
So if I can borrow their money along the way, and then they can pay that loan back with the death benefit, which was never my money to begin with. I love that scenario of I'll save my money, you pay my bills, and then you pay yourself back later. That's effectively what's happening here. So what it does is allows us to take this non-discretionary dollars that were associated with bills. We can grow it like we talked about. If you see here, Mr. and Mrs. here, he's got the 70% of the bills and she's got the 5 to 10%. We combine those two, we put it in this latent wealth strategy, and we get that money to grow. It's going to be growing uninterrupted indefinitely for the duration of our life. In turn, since we're growing that money, we're going to go to the insurance company and say, hey, we've got all this money with you. We'd like to make a loan. And they will give us the loan, and then we'll pay the bills, not with our money, but with the loan money. Does that make sense?
Right.
And
Yeah, absolutely.
and our money, it continues to grow. Here's what actually happens. The dollar that we normally get that was originally intended to pay our bills now gets growth. So we are growing money that we've never been able to grow before. It's an important thing. The bank has always grown this money. They've always made the money. We've just never gotten any of it. But now we can grow it, get that money, and we can also pay our bills. So we're getting kind of a 2-for-1 on that. And that makes significant wealth accumulation part of our life without ever actually doing anything different. Look at the benefits that we get from doing this. We get to take dollars, both the non-discretionary and the discretionary dollars, and we get to leverage that and grow it in a way we've never been able to before. We get tax-free growth. This kind of emulates or mirrors what we might get in a 401k, but we're not only doing it with the regular dollars that we try to grow, we're also doing it with the dollars that we've never grown before. So we're growing huge amounts of dollars in a tax-free environment. The other thing that's particularly nice about that is we get to use that money in a tax-free scenario because of this loan provision. We have access to that money without penalties or taxes. Think about the money that typically goes to long-term growth. We usually put that in an IRA or a 401k or a pension or something like that. And that's nice that it's growing, and it's nice that it's growing tax-free. But if we ever needed that, it comes with a penalty or taxes, right?
Correct.
So if we could get the same growth in a tax-free environment, but not have a penalty or a tax at the time we need it short of retirement, that would be a better advantage, all things being equal. One of the things you get in this strategy with latent wealth is the ability to protect any of your resources against any sort of outside claims, lawsuits, judgments, taxes. Let's say you're driving down the road, you're doing your business, and you get in a car wreck and somebody sues you and they think you need $1 million and you lose that. Immediately, you have now a judgment obligation, your life's changed. And they can do things to capture money. That being said, any money that you have in this type of strategy is off limits to any of that. You may have the judgment, but they can't come and claim your money without your permission or without you choosing to offer it up. So this is a protection mechanism that's just part of the deal. A lot of people aren't aware of that. The other thing this will do, just like your 401k, IRA, or any other long-term saving, it's going to generate a lifetime of retirement income. It's also going to do something that very few people think about. Structuring this the way latent wealth does preserves your Social Security and Medicare benefits. Let's talk about that for half a second. No one's real excited about what they're getting out of Social Security. It's kind of been an anemic plan. But given that we are contributing to it, we'd at least like something out of it. True?
Right. Absolutely.
So, and unfortunately, this is a government plan, so they make the rules. They didn't ask our opinion. We don't chip in on any negotiation of those rules. They just mandate them for us, and we are subject to their I guess, the power they have to put that in place. Here's one of the things very few people think about. If you earn too much money, you eliminate your benefits of Social Security and Medicare. Now think about this for a minute. If you were the high income earner, then you were probably one of the larger contributors to those two plans, true?
Right, correct.
Percentage wise, if I make more, I contribute more. Now, if I'm successful, like everyone tries to be in life, and we are so successful that we actually disqualify ourselves from our own contributions of Medicare and Social Security, that would be kind of a kick in the teeth. The rules are written such that if there's a potential for you to out earn your ability to get your own retirement benefits that you've contributed to. So this latent wealth strategy protects against that. You can earn and be a zillionaire and still maintain your Social Security benefits under this latent wealth strategy. The other thing that I think everybody would like to do is leave some sort of legacy to their family when they leave. We worked hard, we had a good family, and here's something to make your life a little bit better along the way. In today's environment, because things are so competitive, it's very difficult with only saving 5 or 10% of our dollars let alone to pay our own retirement, but leave something for our family. And this structure allows us to probably leave more than we ever would in any other condition. And then, of course, we have the tax-free transfer of that wealth. There are so many rules about death tax and probate and gift tax and all the kind of things that might be part of your plan at death that would interfere with what would otherwise be a good legacy. This avoids every bit of that. Anything that's structured in this latent wealth strategy will pass from us to our heirs without any of those complications or expenses associated with death outside of this type of strategy. So kind of come full circle. What latent wealth has done is recognize what banks are good for, what insurance companies are good for, and what Wall Street is good for. And then we've taken those tools and used them to our advantage. And so by doing so, we can effectively change nothing in our lives. We don't have to change our earning or our spending, yet we can multiply and create all these things we just talked about in really an effortless environment. So that's what we like to do. We like to, once people understand this general concept, we like to meet with them on a specific basis of what are your earnings, what are your goals, what are you trying to accomplish, where are you in your life, and can we apply this strategy to better improve your own existing planning. That's kind of the space we live in, and it works out pretty good.
I feel like this is the time where we all start to clap. That was really impressive, and some really, really well thought out information that I think a lot of people want to know about. This is fascinating to me because I think the first question that most people have is qualifications. Who qualifies for something like this?
So good question on that. Can I stop sharing here? Do you no longer see my screen now?
No, we still see it. I
Oh.
think at the bottom you can click stop share screen.
Oh, there we go. Sorry about that.
There you go.
Just so it's not a distraction there. Remind me of your question, John. I'm sorry.
I guess I'm going to come from a general American family's question is qualifications, because we're so used to having to qualify because of credit score and credit and bank history and so forth. But what kind of people qualify for this strategy?
So great question. Anybody that has some sort of consistency in their life, meaning my job is consistent, I'm earning, I know what my bills are, I know what I'm trying to save. That's what it takes to do this is kind of that structure. So it's not an income qualification. It's not a credit score qualification. It's really, if you are working in a consistent manner to try to live for today and plan for tomorrow, then you're probably a pretty good candidate.
And pretty much anyone who would qualify for a life insurance policy in general, who can pay the premiums, who can pay what is necessary, that would be kind of like a minimum viable qualification. But like you said, the qualifications really are just consistency. You've got something rolling, you've got a job that keeps you paid, and you're in a good boat.
One of the things that's interesting about that, when people consider life insurance, if I came to you and said, hey, John, if you die, your family's going to be suspended here and challenged. So let's look at purchasing a life insurance that would meet the obligations, financial obligations your family needs if you were to pass. And so you would say, well, this is how much I make, and this is what my family's going to need in my absence. And so people usually back into a number. Those conversations are interesting because if you and I are talking about that, let's face it, you don't think you're going to die right now, right?
Right.
So you don't really feel like you really need the insurance right now. So the only compelling thing that I can offer you in the absence of something you don't believe is going to happen is a very, try to get as cheap as I can in that premium. And so I don't care how cheap it is, it still becomes a new budgetary item for you, right?
Right.
I got my mortgage, I got my house, I got my food, and now I have an insurance premium. So I have just added an amount of money to my non-discretionary pile, and I've now minimized my discretionary. I've got a little bit less to do what I was going to do otherwise. It's not a bad thing to do, not being critical of that. It's just added a budgetary item, to your household budget, correct?
Correct.
And so at Latent Wealth, if you look at what we are doing here, We're talking about mortgage dollars that you've already signed up for, car payment dollars that you've already signed up for, student loan bills that you've already signed up for, and then your savings that you've already signed up for. Those are the dollars that we are accumulating together to put in this structure. Have we talked about a premium, a life insurance premium on this?
No, not at all.
No, we don't need to,
No.
because the policy structure with those dollars generates enough earnings that it offsets the premium that would be there. So we're not adding a budgetary item to your list of bills. What we're doing is we're taking your bills and taking what was otherwise a liability and turning it into an asset. And so we're not just going through life with a line item budget, a line item on your budget. What we're doing is we're saying, let's use the dollars you're already spending, the dollars that the banks are already earning money on, the dollars that insurance companies are already earning money on, and let's be a participant in those earnings. And those earnings are substantial enough that they offset your premium and they contribute to your retirement.
That's awesome. That's amazing. So if pretty much everybody, as long as there's consistency in their life, they qualify for this. And it doesn't matter what your income is. It doesn't matter if this is because it won't be taxed. It's growth on the discretionary dollars that you're already planning on using, but finding opportunities to grow them at a higher rate.
Right. One of the things that I find, we talked about this at the very beginning. We talked about this agenda structure. Think about who puts the rules in place for financial services. It's the company who created the product. They want a profit center, so they build the product with a profit center. And then they go and they have to deal with the governments who create the regulations. Right. So when you think of a 401k, a 401k is a great plan, maybe. Let's talk about it. On the surface, it says, great, I made some money and I don't have to pay taxes. We hate paying taxes. So if I don't have to pay taxes on that money now, I can grow more money that'll accumulate to the future. And that seems like a pretty good idea. But the people who organized that product is the government coupled with the financial services industry. So Wall Street used to be only for wealthy people that had enough money to invest in Wall Street, right? And somebody said, all the rich people are playing in Wall Street and now we can't make any more money. Somebody came up with a product idea and said, hey, let's go to middle America. Let's create the opportunity for them to chip in a few bucks out of every paycheck. Maybe it's a mutual fund, maybe it's a 401k, but we have now introduced investment to middle America, what they could never do before. And so that's a great opportunity, but it was somebody in the industry that was looking for more people to sell their product to, and they come to middle America, and now middle America can make money and participate in the stock market in a way they never could before. But when you couple the restrictions of what a 401k is, this may sound like I have a chip on my shoulder, but the fact that the government knows we hate paying taxes, and so they say, let's defer your tax now so you can grow more money. That's a great introductory to a sentence or a conversation. But anybody who would say, okay, so I take $100 and let's say I grow that 100 to $10,000. What's my tax rate on $10,000? It's higher than 100 for sure.
Yeah.
And since the government won't tell us what our tax rate's going to be when we retire, that's an open-ended, potentially problematic situation.
Right.
Why would we defer taxes now when they're low to a big number when they might be high? That is the unknown. Why would we put money away today for the next 30 years knowing that we might have a hiccup in the next 30 years and not have access to that without a significant penalty? Who made that rule, and why didn't we get an opportunity to talk about it? And so I know a lot of people that are saving, doing things and having a great life, and then something happens, they get sick, ill, somebody gets injured or dies, or they lose their job, and their only real source of money has been put to the future in a 401k plan. So they have to go get it. Maybe it looks like $100,000 on paper, but then that $100,000 hasn't been taxed, and there's a 10% penalty that comes with that. So if I needed $20,000 or $25,000, I say, okay, I need to take 25, and they say, well, 25 is really going to spend about like 15 because we got a $2,500 penalty and taxes on 25 is $8,000.
Right.
So I need 8,000, I need 9,500. You're down to 15. Well, 15 doesn't cover my problem. So I need to go get 40,000 so I can pay the penalty and tax so I can net out 25. And I've just decimated years and years and years of accumulation because I had a hiccup in my life. That's absurd that those are the rules we live by, but they're there. If we can take those same dollars, put them in a structure that Latent Wealth proposes, and you need that 25,000, it's there, and it doesn't come with a tax and it doesn't come with a penalty. So we don't need 40 to get to 25. We only need 25 to get to 25.
Right.
And so we're in a much better scenario. And because of loan provision, we don't actually get our 25. Our 25 keeps growing. We use the 25 from the insurance company for that emergency, and we're in better shape. So we can get all that's good, but we can eliminate most of what's bad in that scenario. And the difference is how we structure the cost of the premium. That's the only thing that is a discussion point as to why one would be better than the other. And insurance is always cheaper than taxes. It's always cheaper than penalties. And so we love that component part of it.
Ah, that's awesome. Another question I might ask, and that I might be asked on others' behalves, is as they dig deeper into understanding this particular strategy. We know that if this is something that everyone could do, why isn't everyone doing it? But that's not necessarily my question. My question is if everyone is able to do it, but no one's doing it, not all insurance companies are probably offering this. And this kind of leads back over to you, Mark, with your tenured experience in business. You have relationships with some of the best providers to where you guys can work and tap into the death benefit. But I guess the question is directed at what are some of the trusted groups that allow us to tap into that?
So Latent Wealth likes to look at itself, as we mentioned earlier, a consumer education group, kind of a consumer advocate.
Yeah.
And so not only do we work with insurance companies, but we work with financial service people. We work with agents that are looking out for their clients' best interest. We have relationships with venture capital groups. So if you think about what we're trying to do, remember the three industries, there's the banks, there's the insurance, and there's Wall Street. We need all of them. We need banks, we need insurance, and we need Wall Street. As consumers, we need that. But we only need banks for bill pay, really. We only need insurance to hold money that is intended to grow for the future.
Uh-huh.
And then we need Wall Street for those growth opportunities. So we have relationships and partnerships with banks, insurance groups, and people that work in Wall Street. So we can be a complete value add to our clients. And so different clients are going to have different objectives and different goals. But what we always want to do is say, whatever you're doing, I think we can make better. You're doing what you thought was best, and if it is best, then there will be no application for what we're doing. But if there is value to what we bring to the table, we want to create just better use of your same dollar. Yeah. So when it comes to insurance structure, depending on what you need, there are companies that we can go to that can be low cost or blended products or different kind of things that lower the cost to give you the advantage. If we're talking about going to Wall Street or an investment opportunity, what we try to do there for our clients is put them in touch with people that might have a better average return, so above average return, for below average risk. So risk and reward always seem to kind of go together. And what we try to do is find things where we can have a greater opportunity for upside and a lower chance of downside. And so that enhances our clients' benefits as well.
Awesome. I guess my only last question would be is, you've answered everything I've asked, and I think covered everything that everyone else posted in the comment section. But my question was how does someone start? How do they get started with this? What are the steps that need to be taken? Is it a quick process? Does it take a while? What's the turnaround point to get started with a latent wealth strategy?
Again, thank you for that great question. It's pretty simple. everything's already in place. You're already earning what you're earning. You already got your disciplines that you're doing. So what we simply need to do with our clients is gather a little information, understand their objectives and goals, and then we'll present, or we'll create a plan, and it'll either make sense or it needs a little bit of tweaking. And then we'll put that in play, and probably 3 weeks to a month, you're fully functional.
Wow. That's pretty liquid. That's awesome. I think a lot of people will want to know that because, especially and this is relevant because of times, but irrelevant for longevity, as people are in quarantine, or if people are facing particular lifestyle changes due to cultural and economic bounds. I think people are going to want to know the timeline, but as easy as giving you the information and then being underway in less than 6 weeks or so, that's pretty awesome.
One of the things that's compelling about this a little bit, where we started this conversation, if we were talking about a life insurance policy for you, you don't see a compelling reason to move on it today.
Right.
You're not going to die today, and so we'll do that tomorrow. And if you were perfect in your timing, you'd buy life insurance the day before you die. That's the best return, right? $1 in, $1 million out. But we can't chart that. But what we're doing here with Latent Wealth Strategies is your money can start growing on day one. And so you're going to be alive, your whole life. You're going to be alive that long. And so if your money can grow and accumulate, whether you die or don't die anytime soon, you've got, a lifetime of accumulation, a lifetime of tax-free opportunity, a lifetime of investment strategies outside of that. So there is a reason to look at it maybe now, sooner rather than later. One of the challenges that people will say in their budget is, I can't do this now, but next year when I get a raise, I'll have some money that I can do some things, right? And two things I want to point out on that. If you skip a year, let's say we're going to invest for 25 years before you retire, but you can't quite do it now, but you can do it next year. So 25 years now becomes 24 years, right?
Right.
The year you cut off is not year one, it's year 25. Well, year 25 is the biggest single year of income you'll earn in that whole 25-year process. So delaying is where we might say, oh, we're only saving $500 a month or whatever it is. That's not that much in any given year. That's not the year that is forfeited. It's the year that went from $600,000 to $700,000, or $1 million to $1.1 million, or something like that. So that's the one thing to think about. But the other thing to think about is, because this doesn't require any additional savings or money or this or that, there's no reason not to consider that. Whatever was a budgetary concern that you couldn't manage is completely manageable now, because it's not a budgetary item.
Interesting.
Another comment I have on that, just kind of piggybacking off of that, is a lot of people think the same thing, waiting for the raise or more money to come in. There might be other cool strategies that people are familiar with. I know everybody loves real estate. A lot of people like cryptocurrency, kind of whatever the deal is. This isn't done in place of those things. This is something that can be used as a platform to actually propel people into those other cooler, potentially investment strategies, and get them into them a little bit quicker. So it's not this instead of that. This allows you to get into other things and hopefully even a little bit quicker than you would have otherwise been able to do.
Oh, interesting.
That's actually a powerful point.
Yeah.
It's worth, sitting and thinking on that for a moment. If I have the dollars that were sitting in the bank at 0% return, that's what I've got, right? And if I was going to move it to an investment to get 10%, so I went from 0 to 10%, and I've got that going, so I can count on 10%. What Stephen's saying here is, if I move my dollars from 0 into a policy, and I'm just going to pick a number here, but let's say that number is 5%. So I'm growing at 5% in the policy, and while my money's in this policy at 5%, I see an opportunity for 10% growth outside the policy. So I go to the insurance industry, and I borrow the money I need for that 10% policy or 10% investment. I maintain the 5% I'm getting in the policy, and I get the other 10% outside. So what looked like a 10% investment is now a 15% investment.
Right.
those are not marginal differences. And so to go from 0 to 10 or from 5 to 15 will make a lot of difference for a lot of people. I think we mentioned this before. The lowest I've ever seen this benefit anybody is in the hundreds of thousands of dollars. Obviously you can get into the millions and have millions of dollars of benefit, but if your low end is hundreds of thousands of benefit, that's pretty impressive. And when you figure out what did I do to get extra hundreds of thousands of dollars, the answer will be pretty much nothing.
Yeah. You've changed nothing. You've done nothing. Even if it is hundreds of thousands of dollars, spread that over monthly increments over time. That's pretty awesome.
Right. So we're proud of what we've come up with. We think people benefit from it. We do find that people like it. They ask the same question: why would people not do this?
Yeah.
How come I haven't heard of this before? Those are pretty standard questions. The answer is, who would teach you that? Who knows this information that would most likely want to share it with you? And that would be the financial services industry, right? But if the banks can give you zero money and give you zero interest on your money, why would they share a way to get more? If
Right.
the insurance company can keep all that, why would they share that? And so again, not trying to pit ourselves against the industry, but the industry's agenda is to make as much money as they can. And our agenda is to make as much money as we can. So where there's conflict between us and them in this unique scenario, we need somebody that understands the industry, but really is looking to help the consumer maybe balance that out where it might have been a little bit out of balance, to the industry side. And frankly, if everybody came together and was fair about that, we probably wouldn't be retiring in Walmarts or big box stores or alternative incomes or things like that.
Yeah.
It might be a little bit, more balanced in the share of the gains, but it's not. And so if we can know the rules and apply them to our agenda instead of their agenda, then we are the benefactor of that. So that's kind of where Latent Wealth tries to position themselves, to help people gain a little bit of a better understanding what those rules are, how they might affect them, and then to the extent that they can apply them, then they win.
Awesome. Well, that's covered pretty much all of my questions, and you guys have blown it out of the water. This is pretty cool. Again, why wouldn't everyone do this? Who's willing to teach it? You guys are here to help with that. Awesome stuff. Any other thoughts you have as we close this out?
I think I've told you everything I know. I got nothing else.
That's not true.
Steve,
No, that's it. That's it.
Good stuff. I'll
Good deal. Thanks, John.
Yeah, absolutely. I'll stop the recording here.